My next guest, John Calamos from Calamos Investments. He's the chairman, CEO, and global co-chief investment officer at Calamos with $24 billion in assets under management. It's great to see you, sir.
Glad to be here.
Thank you so much for joining us. Okay, particularly now as we kick off a new quarter after what was the worst quarter, the third quarter in 4 years, Sandra. Yeah. So what do you do now after where we just came off of, John?
Well, I think what you don't do is panic out of the market here. And I think that's what happens in the volatility we're seeing, where you have a lot of individual investors just get whipsawed out of the market at the wrong time. I think I'm looking forward to a much better fourth quarter in here. And I think I would be more worried if I thought there was a recession about to happen. I don't think there's a recession. I think we're still in a slow growth environment. And from that point of view, we're positive. But volatility is going to continue to be very, very high in here.
And that's the crux of the debate, because Keith McCullough is looking at PMI reports, the Purchasing Managers Index, and yesterday the PMI in the U.S. indicated contraction. It
was an actual recessionary number. I know a lot of people are trying to game the Chinese number, but yesterday, the Chicago PMI number went from 54.4 to 48.7, which is by all measures a contractionary or recessionary number. Does that worry you? Does the recessionary fear come into play?
Yeah, well, we've been a bit more defensive in here. It does worry us. We're looking at the numbers just like you are, week to week, day to day. But it still does seem overall we're in a slow growth. We don't want to just hang on one number in there.
No, exactly. I wouldn't either. A better question, I think, though, is how did we get to the all-time bubble high on slow growth numbers? We have gone through multiple bubbles. The 2000 bubble, 2007, as you know now, 2015. The all-time high in the stock market didn't quite have the economic fundamentals that you might think.
Yeah. Well, we still were in a slow growth environment, in that. And
no alternatives. Yeah. No alternatives. You got the Federal Reserve with easy money. Where are you going to put your money?
Quite frankly,
how we got there, you're searching for yield.
Yeah, quite frankly, I'm a bit more worried about the bond market than the equity markets in here.
What is it telling you right now?
Well, it's the bond market is really, I've seen this happen in the past. People are hiding in the bond market, and then interest rates take off and go up, and here they think they're in a safe place and they get hammered.
But couldn't you say the same thing about stocks? People thought they were safe long the FANGs and long everything else, the biotech stocks, and they're the ones who got hammered. We've been long bonds and we didn't get hammered in the last 3 months.
Yeah. Well, that's a good point. I think one of the things, there is too much emphasis on the Fed and monetary policy, not enough on fiscal policy.
Yeah, for sure. We've been talking about that.
And the healthcare is a good example of that. Yep. A tweet comes out and the whole... and what is that telling you is it tells you that investors are very concerned about fiscal policy.
Big time.
So you're saying the Hillary Clinton tweet on drug prices?
That's right.
It did crush. It was the catalyst for the biotech stocks.
Yeah, and I think that's a good example of being worried about where's our fiscal policy here. Yep. We got too much regulation. It's slowing growth. Are they going to control drug prices for us?
No, exactly. And how about the next catalyst? Like Maria was talking about this earlier, but what does Bernie Sanders raising a record amount of money mean for the next stage of policy catalyst?
I think that's why we're going to have volatility.
92% tax rates.
Yeah, and this is going to go on for months and months, as you know. So, every headline is going to be.
And a lot of people have a hard time tying together the politics with business. And spoken like a true Chicago guy, growing up on the commodities floors in Chicago, we watched the bond market before the stock market, right? Yeah. And he said it so eloquently in his Chicago accent, didn't he? By the way, a Cubs fan. Right? But you've got to navigate through this. You've got to put that money at work. You've got a lot of assets under management. Yeah. There are people who want to be aggressive in this environment. Yeah. If you do, what do you do right now?
Well, I think it's not whether to be in stocks or bonds, not one or the other. It's really how much you're weighting one against the other. To me, it's not one. I don't go 100% one way, 100% the other way. So on the fixed income side, on the bond side, use of alternatives We do convertible arbitrage in that.
Convertible bonds you like?
Convertible bonds, convertible strategies there, because it really takes away a lot of the interest rate risk. And that's what we have there right now. And even in the equity markets, the convertibles tend to dampen volatility. And quite frankly, I'm in the camp that I'd like to see us see rates go up and get into a normal interest rate environment.
Will they do it this year? It's anybody's guess, right?
Yeah, it's anybody's guess. It's not if they do it,
it's
when.
But the when might be 2016.
And on converts, this is one of the best ideas we've heard in a long time because nobody else has had it. I played golf with Frank Pratt the other day, who ran converts at Morgan Stanley, as you know, for a long time, and he was talking about how attractive the convert market is and how misunderstood. People actually have stopped talking about it. Yeah,
we're seeing, at this point, even tactically, using convertibles as part of the fixed income allocation makes a lot of sense because over the past 20 years, every time interest rates went up, convertibles had outperformed the bond market in that environment.
So what do you do? You buy the bonds and then it converts. How does it work? Explain to our viewers who don't understand convertible bonds.
Well, convertible bonds they have all the bond attributes, but what they have is any time as a holder of that bond, you can convert into a specified number of shares of common stock.
So it converts into a stock.
Right. Yeah. So the positive to that is you get the upside of the stock, but you have the downside safety of the bond attributes. It doesn't mean you don't have any downside. It cushions the downside.
Real quick, before you go, John, I just got to get a word on energy. Oil close to $50 now. You're still underweight energy.
I think, again, the positive on energy prices is still, we haven't seen it happen yet, but the consumer, it's like a tax cut for the consumer. We hope that happens.
How come it hasn't happened yet?
Yeah,
they're probably getting it. It's just getting taxed everywhere else. Healthcare, rent. Look at the cost of living.
That's absolutely right, because you save $100 at the gas pump, but then you had to pay $160 for your affordable care. So you're right. It is healthcare and your rent.
It does seem, though, that the oil is going into much more of a supply and demand rather than a controlled price. And that's what we've seen over many decades. It's more of a controlled price. Now it's much more supply and demand. How positive is it that the Americas, North America and South America, can be independent of energy?
Totally.
That is, think about that, what has to do with our foreign policy savings and others. So that's a positive. Maybe I'm just long-term bullish here, but
you see the glass as half full, John. Don't apologize for that.
My glass
John Calamos, good to see you as always.
Great to be with you.
Thank you so much for joining us. John Calamos is